Brace yourself. A financial heart attack could be looming for the U.S. stock market. This isn't just clickbait. It's coming from Ray Dalio, one of the world's most influential investors. Dalio, the legendary founder of Bridgewater Associates, is sounding the alarm. With Wall Street at historic highs, swelling U.S. government debt and escalating global tensions are creating a brewing storm that most investors aren't prepared for. But here's where it gets controversial. Dalio's remedy isn't what everyone expects. Instead of suggesting more stocks or bonds, he urges investors to protect their portfolios with a strategic allocation to gold. Why gold? Dalio insists it acts as a financial shield when markets are, in his words, unhealthy due to too much debt and rising global risks. Speaking recently at the launch event of Abu Dhabi Finance Week, Dalio drew a bold comparison between America's overextended finances and a clogged artery. Just as excessive plaque can cause a human's heart attack, relentless debt payments squeeze out other spending, threatening to cripple the broader economy. He cautioned, a doctor would warn of a heart attack, and that same level of seriousness should be applied here. So what's Dalio's actual advice? He argues for a diversified investment approach. In his opinion, allocating 10 to 15% of your holdings to gold is prudent. According to Dalio, the true value of gold lies in its lack of correlation with other assets, meaning when traditional markets crash, gold often holds its ground or even rises, offering much-needed balance and protection. Here's the part most people miss. Dalio urges every investor to ponder, whose money do you own? In an age of surging debt and mounting global volatility, this question isn't just philosophical. It could decide your financial survival. There's more fuel for debate. At the time of Dalio's comments, gold prices were scaling new highs globally, propelled by robust central bank purchases, a weaker U.S. dollar, and what many see as overly cautious global monetary policy. In fact, gold has notched a roughly 40% surge year to date, starkly outpacing many traditional assets. Yet, paradoxically, U.S. stock indices, like the S&P 500 and NASDAQ, also keep rewriting record books, thanks in part to hopes that the Federal Reserve might soon lower interest rates after favorable inflation data. And this is where opinions clash. Could gold's dazzling run continue even as stocks hit new highs? Or is Dalio's warning too pessimistic for today's bull market? Does his portfolio tip, up to 15% in gold, make sense for everyone? Or could it be too defensive? What do you think? Is Dalio's take a needed wake-up call, or is he being alarmist? Should average investors really move a chunk of their savings into gold? Or is this overkill in a modern, tech-driven economy? Let's get the debate started. Drop your take in the comments below. Disclaimer: this article is meant for educational purposes only. The ideas and suggestions discussed reflect personal views and not those of this publication or its partners. Always seek advice from certified financial professionals before making any investment moves, as the market's twists and turns can catch anyone off guard.